Eddie Ghabour with us this morning. First question, obvious one. What are the chances that the Fed will pull off a tightening move in this inflationary period without disrupting the markets?
The probability is extremely low, Stuart. I've been crystal clear in the fact that the Federal Reserve has made one of the worst miscalculations of inflation in modern day history. For 12 months, the rate of change of inflation has been increasing at a historic rate. And now, finally, when we're at possibly peak inflation, they want to tighten and start accelerating tapering, heading into a slowdown. There's a reason why my Twitter handle is Common Sense Bull. You know better than anyone, I've been very bullish for years on your show. This is the most cautious I've been in years heading into the new year. And so if we get a Santa Claus rally, I'm pounding the table again for investors. We've already done this for clients last week. Start de-risking if you want to make sure you're sitting in the catbird seat when we see a correction heading into next year, because the market has sent crystal clear signals that we are starting to head into a slowdown. And with the Fed going to have to accelerate tightening, it's going to be a very problematic thing for risk assets. So if you're not actively managing around this, you're going to be in serious trouble, in my opinion.
Okay, can I put that into plain English? You are selling any rally, correct?
That is correct, but I want to be clear. We're selling cyclical stocks, small cap stocks, mid cap stocks, financials. We want to own staples, utilities, healthcare, and then we want to also potentially have some cash to be able to buy the dip that we think is going to happen next year. We've already seen a big sell-off in some of these risk assets already. The signal is clear.
Well, we've seen a big sell-off in big tech. Are you buying it on the expectation of a bounce? I'm just talking big tech now.
We are not adding to big tech right now. The next move for us with big tech will be sometime in January. We're going to start taking profits from big tech and playing more defense, because the bigger headwinds are going to start to materialize in the second half of the first quarter next year.
Okay, again, put it into plain English. The second half of the first quarter of next year. You're talking February, late February, early March. That's when the selling comes. Again, I'm trying to be plain English here. Is that what you're forecasting?
That's exactly right. Look, the yield curve has flattened. Look at the 2s and 10s. And the GDP is starting to slow down. You're telling me the Fed is going to tighten while the yield curve is flat and GDP is slowing down, and risk assets are not going to sell off here? I just don't buy that. So we've had a hell of a year and a half. Clients have made a ton of money. Now we're going to be sitting and playing defense.
All right. That was plain English, and we understand it. Thank you very much indeed, Eddie Ghabour. That was good stuff, man. Appreciate it.